Puts, options, explained. Puts, options, explained. Explaining put options for beginners. Why is this S at the end of put? The reason why that S is there is because apparently people are searching for puts, options explained, as well as put options explained. And who am I to tell the people are wrong? If the people want it, then let's give the people what they want. And the people want to know, what are put options? A put option is a legal contract that gives the buyer of the put option the right to sell a specific asset at a predetermined price for a specific time frame. This predetermined price is known as the strike price. The seller of the put option has the obligation to fulfill this contract. So two people are parties, and there's an asset involved. One person has the asset, the other person is okay with buying it. They create a contract. The person with the asset buys the contract from this other person, and it's basically a legal commitment saying, hey, you'll buy this asset from me in this certain amount of time at this certain price if certain conditions arise. Put options are used in a wide range of assets such as stocks, indexes, cryptocurrencies, futures, and commodities. Basically, all assets in the financial markets could be optionable, but they aren't necessarily optionable. There needs to be an options market structured around it, and sometimes there is, sometimes there isn't. You could create a put option with your neighbor or anyone you know. All you really need is two people that are agreeing upon these terms. But for our purposes, we're talking about basically the stock market. The price of a put option. Put option has a price. If one person's buying it, one person's selling it, there needs to be a price, right? And there are different factors that affect the price. What are some of those factors? Changes in the price of the underlying asset. So if we are looking at a put option for ABC stock that's currently trading at $10, if ABC stock moves up or down, that has an impact on the option price. Another thing, if the strike price is closer or further away from the underlying asset price. So for example, we're talking about ABC stock, it's trading at $10. If the put option strike price is at 8, it's going to be one price. If it's at 4, it's going to be another price. The further away from the asset's current trading price, then the impact of that distance, getting further and further away from the current market price, will have a decreasing factor on the value of the put option. How much time is in the contract? If you are buying a put option that has a year's worth of value versus a month's worth of value, two different prices. Interest rates. For the trading that I've done, this has been the one that has really affected me the least. The underlying asset and or market volatility. Volatility is basically how much something is moving. And whether it's moving a lot or whether it's moving a little, you know, when it's not volatile, when it doesn't move much, it's way more predictable. And when you're doing contracts, the more predictable something is, then it's easier to balance out. When it's less predictable, there's a price to pay for that. And these factors are known as the option Greeks. The price of the put option increases if the underlying asset falls in price. The put option, remember, is saying that you'll buy something if it goes down. It's basically an insurance policy on a stock. So if we got a stock, we're looking at $10 and it starts falling down to 8, then the put option becomes more valuable because it's closer to needing to be exercised. If volatility increases, the price of the put option will increase. As I was talking about, this unpredictability, things start really moving a lot. If interest rates decline, the price of the put option decreases if the opposites happen. The underlying asset rises in price. Instead of going from 10 to 8, it starts moving up from 10 to 11 to 12. If volatility decreases, if things kind of start stabilizing, then that will have a decreasing impact on the value of a put option. If interest rates increases, and if as time passes, so if you sold someone a put option for 6 months, right? You've got a big time value there of 6 months. By the time you're at 3 months, half that time value is gone, so it decreases. And how would this affect different things? Well, if you're buying or selling a put option, then these factors come into play in different ways, and depending on what you're wanting to do. Does it seem a little complicated? If it seems a little complicated, then the easiest way to begin trading put options is by selling cash secured put options. And if you're wondering how to do that, boom, I got you covered right here on the same YouTube channel that you're watching this video on right now. Watch this to learn how to sell cash secured put options. I'll link to it at the end. If for some reason it's not there, find it on your own. Speaking of finding something, go over to ihavesuccess.com and find this. Find yourself a free copy of the 3 underused tactics to transform your financial results. Not necessarily easy, but effective. With that, ladies and gentlemen, you guys have a fantastic night, and I will see you later.